Was that day for me? Just got word that my office lease coming up should be finalized. I can't wait to share with you the details, but that's right. Client First Strategy is moving to its new local, global, national. We're doing it all. New headquarters. We're just moving across the street. We're going to stay on Route 110 right here in Broad Hollow Road. This is the place to be. And it's just, I don't see myself working anywhere else. This is just such a convenient place for people to be. We have such good restaurants up and down the strip. It's such a great place to work. I have to say, like, I don't know if anybody loves Broad Hollow Road, Route 110 more than me. I love living right here. I love working here. And it's just like, it's the mecca of Long Island. I could see clients here from all over the place, including the city. So I'll be moving soon. We're going to have brand new state of the art offices. The conference room is going to be beautiful. Got to get the furniture going. Just got to get the lease going. I'll put up like the blueprint, like what it's going to look like on the screen as soon as I have it. But anyway, so took care of that. Took care of some personal shit today. We all have that stuff. So it's just whatever. Got it all done. Do you blur the lines between like a business and personal? Like sometimes you work in personal, sometimes business. Your day just goes by. That's how my life is. But I gave up separating personal from business a long time ago. It's just too hard because I am who I am. And someone gave me a compliment today from the radio show. They said you are smart, knowledgeable, and warm. It's a pleasure to listen to you. Wow, that was a nice compliment to get today. Oh man, that was such a nice compliment. So I want to talk to you about a couple of things. First, we had the CPI number that came out this morning, Consumer Price Index. Inflation ticking a little bit lower, still about 5% year over year. And what I said to you yesterday is that we are all looking, not we, not you and me, everyone else is looking for this all or none magical number that's going to determine everything. CPI, one number, one economic statistic comes in to our liking, a little better than expected. We're back off to the races. Everything's great. Stocks go to new highs. Every stock that you're down is going to go up, and you're going to have all this extra money. And I keep telling you, and I want to just reinforce, there's no such thing as that. There's no magical economic statistic. Not one. Now, there could be trends, but that's a different story. So, and I said to you, as soon as we get the CPI, we'll talk about it for about a half hour. Comes out 8:30 in the morning today. It's news for about a half hour. And then after that, we're worried about the next day, tomorrow's economic statistic, tomorrow, which is the producer price index. And then we'll get over that in a day or so, a half hour. And then Friday, we have retail sales figures. And we have earnings from United Healthcare, JP Morgan, Wells Fargo. The important thing is, what's JP Morgan and Wells Fargo going to say about the state of the banking industry since the Silicon Valley debacle and the bank crisis, which I don't know if you call it a crisis, it's past us already, but they're going to give us some insights into whether or not the financial services, well, whether banks are going to pull back on lending. I want think about this, okay? And then I'm going to run the intro. Just think about this. When you borrow money from the bank, you're actually borrowing money from the other depositors of the bank. And when someone borrows money from a bank, they're borrowing your money. Think about that. Does that blow your mind? You're just all borrowing and, lending to each other. You're borrowing from and lending to each other. That's all it is. Banks take in deposits, and it's their job to make a profit by making loans, right? They invest the money, to the bank. Giving you a loan to the bank, that's investing in you. Even though it's your debt, it's the bank's assets. Just like your deposit is the bank's liability, not their assets. And then banks have to keep a certain amount of money on hand in case their depositors want some money back. And there's regulations that limit how much money banks can leverage up and lend out. Okay, that's how banks work. Pretty crazy, right? Let's roll the intro. We're going to get into the important things, not how the market did today or how it could do tomorrow. That's actually pretty meaningless. We're going to talk about how to read some things in the market for the long term so you don't get thrown off your course. Here we go. Thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. If you want to take this to a one-on-one conversation, if you want to learn more about myself, my firm, my partner, Bobby Bird, you can check us out at clientfirststrategy.com. I am on LinkedIn. You can see the icons here. Mitchell Goldberg, Mitchell Goldberg, AIF, AAMS. The AIF stands for Accredited Investment Fiduciary. The AAMS means Accredited Asset Management Specialist. I'm on YouTube, Client First Strategy. Please subscribe if you're into that sort of thing. I post a lot. Instagram is at InstaMitchG. Facebook, Client First Strategy. And I have a Twitter page, Twitter handle at Mitch_Goldberg. So check those out if you like. If you asking me which of the ones are important to me, I'll tell you what, it's what's important to you. If you like easy to find daily, if you like easy to find daily, quick, 30-second to 1.5 minute videos that just give you clear, simple knowledge in an easy to grasp way, your best bet is Instagram at InstaMitchG. Second is YouTube, and then LinkedIn. I post on Facebook every day also, but I think those are the best places if you want to get to know me and follow me. And then, again, check out clientfirststrategy.com. I'd love to hear from you. And while you're watching this presentation, if you'd like, if you'd be so kind, give us a thumbs up, a heart, a wow reaction, depending on which social media platform you're watching from. That helps me, lets me know you're out there. And it also lets your connections know about the show and the good work we do here. This is all, it's all about education. And if you have any questions about what we're talking about today, hit me up in the comments, or just words of encouragement, words of wisdom are always appreciated in the comments as well. So say hello in the comments. Goldman Sachs gets an upgrade today. I forget who upgrades it. Maybe it was JP Morgan. No, another big bank upgrades Goldman Sachs and says the stock has 20 or 30% upside. It's a great time to buy the stock. Look, obviously, if someone puts a buy recommendation on a stock, it's presumably because they think it's a great time to buy the stock. And then the stock goes up. It could go up 20%, 10%, 30%. Okay. This is going to sound a little arrogant, dare I say, but I'm not in a stock to make 10 or 20%. No. Not good enough. Before you say, whoa, look at you, Mr. Hot Shot Investor or Mr. Big Shot in Finance. And, we all agree that, guys in finance are typically very cool, except for me. I'm just like the nerd of the group, right? But let me explain. The big money to me made in stocks, and I'm a financial advisor, so I have clients in individual stocks. I have clients in exchange traded funds also. I hardly ever use mutual funds, but that's just a matter of personal preference. And if you're my client, you'd understand why. Having said that, and by the way, there are exchange traded funds that track the S&P 500 and the other major averages with dirt cheap expense ratios. That's what I get into. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Boom, I said it. So let me explain. I have clients in stocks. Okay. I have clients in stocks for over 10 years. And profits on these stocks are multifold, 5, 10 times and more. That's what I'm in it for. It's too much of a pain in the ass to buy and sell stocks and try to be in the next hot stock. Because what you do is you just jump from thing to thing to thing. You're just chasing the shiny new object. And my experiences and your experiences, that's a it's a recipe for disaster. And now there's always every year, well, there's always a stock that could go up like a lot in one year. Like so far this year, there's a couple of stocks that are up a lot, but that's not the point. That's the rarity, not the norm. So I'm not looking to buy a stock because an analyst said it could go up 20%. I'm in a stock because I want to hold on to it for 10 years or more. And I want to make 100% plus. And while I'm in the stock, I want to focus on my life, on my career, on my happiness, on my health, on the well-being of my family, on my friends, just having fun. That's what I'm into for stocks. And what I tell clients is we could buy a Goldman Sachs or Microsoft, for example, that has had so many upgrades and downgrades. Buy recommendation, hold recommendation, now to buy, now to hold, now to sell, now to hold, now to buy. And in the time frame that I tell clients, in the time frame that you're going to be invested in the stock, there will be many times over the years where it will get upgrades and downgrades. And so by the time the stock is downgraded, then they have a good quarter, or, whatever metric they're valued on does better. Let's say, it's a Netflix and they're valued on subscribership growth. Okay, if it's Disney, they're valued on subscribership growth to Disney Plus. All of a sudden, you get a metric that comes out better than expected, the main metric that people value the stock on. The stock goes up, and then the analysts eventually will change their mind and upgrade the stock after downgrading the stock. Or they'll dig in their heels and say, no, I'm not. I have to be right about it. Us humans, we have a way of saying something that we could be wrong about and then digging in our heels to be right. We get defensive. Instead of saying, I messed up, let's just move on and learn from it. That is why I don't pay attention to upgrades and downgrades on stocks. I have many individual stocks personally with my clients. They get upgrades and downgrades all the time. I don't make a move on these upgrades and downgrades. I mean, if a downgrade hits and I'm accumulating a stock for clients and the stock is down $1 or $2, a big stock because of that, good, I'll take it. Thank you very much for the bargain. But don't get caught up in the nonsense, okay? Second thing, it's IRA season. It's tax season. Next week is the tax filing deadline, or file your extensions. I want to share with you a big problem, a big thing that's happening with clients in financial planning, with my financial planning clients. Bobby and I go through these financial plans with our clients all the time. Daily is what we do. And the new clients who come in, they're shocked to see that their odds of a successful retirement, meaning not running out of money before the age of 92. Why 92? We use 92 as a projected age of death. Why? Because it's the number we use. If you say 85, people have passed that. You say 100, very few people live to that age. So we go by 92. And people will look at it and say, wow, I thought I would have more money. I thought my money would last longer. If you retire at 65, you're in retirement for almost 30 years. Think about prices of things today, and then think about what they cost 30 years ago. And the other thing is, when you retire, you lose about 1/3 to 40% of your retirement plan. So you have this multi-million-dollar 401k plan. You've got all this money. Let's say you have $2.5 million in your 401k plan, which is a lot. Most people don't have that, but there are those clients that do. And I tell them, but $1 million of it's going to taxes. You have $1.5 million. Try to stretch out that $1.5 million over 30 years. And it's not as great as you think. And it's kind of crushes people. So your biggest expense is taxes. And what I'm telling you is that people need to take advantage of the Roth component of their 401k. This year now, even a SEP IRA could be a Roth. There's a Roth component to a SEP not for 2022, but for the 2023. Most of you are making your contributions to your 2022 right now, not to your 2023. So I'm having a lot of conversations with clients with SEP IRAs. I'm saying, going forward, I think we should do the Roth component. Now, if the tax deduction is such a big deal to them, that's a different story. But at least we're having the conversation. You need to know these things. And then you make up the decision that's best for you. And I always advise speak with your accountant as well. I don't give tax advice. I'm not your tax advisor. I'm not your mama. I'm not your papa. But I do give really good driving directions. And, I could give you like recommendations to good restaurants around here, but I don't give tax advice, except for the part that it comes in the ordinary part of doing business in terms of capital gains. Like if I have a client with a stock that's up a lot and we're going to sell it, and if they could wait 2 more days to get the long-term capital gains tax, I prefer to wait because it's beneficial to the client. Even if the stock goes down a little bit, they're still better off with the capital gains tax as opposed to the short-term capital gains, which is your income tax. So these are the things that we talk about. Okay. What else is there? Let's just take a quick gander about the markets. Okay. So we all know that CPI came out today. PPI, producer price index, comes out tomorrow. And it's all good. It's better. It's all good. I just want to make sure my screen is large enough for you to see it. Let me get rid of the social media icons. So let's get rid of those. Pop myself up here. All right, here I am. Okay. So Dow was off 38. It was up over 100 yesterday. It was up over 100 the day before. It was up about 200 earlier today. And then it petered out, and then it went up a little bit. But by the end of the day, it was down 38 points. NASDAQ was down 102 points. That's less than 1%. S&P down, 0.4%. Not like an overwhelmingly bad day. It's just a general downward bias and what seemed to be more like a slow summer day. It is 82 degrees outside, which is like the first really hot weather day we've had this season. What else? Oil continues to march up. That's going to start to become a problem. See, oil's 83. It just broke above the top of its recent trading range. That's definitely going to be an issue for consumers and for inflation. Oil's been around 72 to 82 per barrel. This is for West Texas Intermediate. This is the stuff that we drill domestically and drill offshore, but very close to the continental shelf or on the continental shelf. I don't know, Gulf of Mexico, right? So it's our domestic oil. It's been 72 to 82. It dropped to about 66 when the Silicon Valley Bank debacle happened just over a month ago. It's recovered, but then Saudi Arabia comes out, OPEC comes out, led by Saudi Arabia, and says, we're cutting 1.1 million barrels of production, and oil shoots up, and here it is 83. We'll see if it can continue that trend, but it does look like a pretty powerful move and a pretty powerful trend. I'm not saying you run out and buy oil stocks right now. I'm saying that oil going up looks like it's going to stick, and you already see gas prices going up across the island and across the country right now. So that's going to hurt a little bit. The VIX remains low at 19. That is just really low. Either there's a lot of complacency out there, or money managers have already taken their positions and they're not really too worried because they're invested so defensively. All right. Let's take a look at this. Let's just take a look. U.S. 30-year mortgage, 30-year 6.42. The inverted yield curve is 0.57. It was 100, negative 104. Now it's negative 57. So it's cut in half. And so these are some of the ETFs I follow. The TIPS, the VIX, we already spoke about that. Big bond fund from Vanguard. And then we talked, MIR. This hardly ever moves. It's not supposed to move. It's ultra short maturity, muni bond, gold. So, I follow interest rates and things that are impacted by interest rates. And let's take a look at bonds. Overall, yields are down across the board. You're still getting 5% for 3 months and 4 months. That'll probably last a little longer because the Fed is still expected to raise rates at least 1 or 2 more times. Now, there's a few schools of thought. Are we going to get the final great, amazing number on the economy, the great economic statistics, one number that's going to make the Fed stop raising rates? That's what people are hoping for today. And I just don't think it's realistic to expect the Fed to change on one statistic. It takes a trend. And the trend, yes, for inflation is going lower. It was 9%. Now it's 5%. We've got to get down to like 3% or 2%. I don't think the Fed gives up and says, 3% or 4%, we're okay now. The Fed said 2%. If they meant 2%, rates are probably going to keep going higher. So I think people are a little overly optimistic in terms of what the Fed's going to do. But that remains to be seen, and that's what makes it fun. In the meantime, I'm just going to keep on trucking. I'm going to keep on investing. I got Grateful Dead in my head now. I know you do too, Natalie. I know you do. And we're going to just keep on keeping on. What's really important, though, claiming Social Security at the right age, investing in a Roth versus a traditional IRA or 401k, backdoor Roth IRA. Oh, you've got to know about these things. So these are the things that are really going to make a difference in your life. 10, 20 years from now, we're not going to remember what happened today, right? We're just not going to remember. But the moves you make today will impact you down the road. And I just want you to make the right moves, okay? Have a great day, everybody. I'm going to get going and enjoy some of this beautiful weather outside. And I hope you guys all have a great day, and I'll see you tomorrow.